Hi everyone. The RBA's term funding facility, which over the last year has driven the interest rate on 3-year fixed rate mortgages in Australia down to record low levels, is coming to an end on the 25th of June. Now, when the term funding facility was introduced in March of last year, it had the effect of decreasing the cost to big banks of making 3-year fixed rate mortgages by about 80 basis points, that is 0.8%, and even more for small banks and credit unions and building societies. Now, those 80 basis points were passed on to homeowners and investors because of the extra competition that banks faced after the big banks faced after the term funding facility was introduced. Competition from small banks and credit unions and building societies. Otherwise, the big banks might have held on to a part of that 80 basis points. So what happens when the term funding facility comes to an end in a few weeks' time? Does it mean that the interest rate on 3-year fixed rate mortgages will jump up by 80 basis points? Well, no, because some big things have changed since March of last year. So what we'll see is that the interest rate on 3-year fixed rate mortgages will jump up by 45 to 55 basis points after the term funding facility comes to an end in a few weeks' time. Now, there's some complicated ideas in there, so we should start off with some more fundamental ideas and quickly work our way up to that. So let's start off with the bank making variable rate loans. And where does it get the money for that? Well, it gets the funding from deposits, about 60%, and it gets the other 40% from the markets. So now let's look at a variable rate loan with variable rate funding and think about the interest rate risk on a variable rate loan. So we've got variable interest rate coming back here. That's going to be about, in March of last year, the cash rate plus 260 basis points. And we're paying for the money into deposits, bank bill, bank bonds, on average, the cash rate plus 40 basis points. So about a 220 basis point spread here. And the bank is well matched in terms of interest rate risk between its assets and its liabilities, because if short-term interest rates go up, if the cash rate goes up, then this variable payments will go up, the cash that it's receiving, and also the money that it's paying into the providers of the funds will go up by the same amount. And an increase in short-term interest rates won't squeeze the bank's margin. Now, that's not true if the bank is making fixed rate loans. In that case, if the cash rate goes up, then there is going to be a squeezing of the margin because we're fixed on this side, the cash flows that are being received. There is a mismatch between the fixed rate assets and the floating rate liabilities of the bank. And that means interest rate risk. Now, banks are not inclined or permitted to hold on to the interest rate risk that they absorb when they make fixed rate loans, including mortgages. What they do is they pass that interest rate risk into the risk markets using instruments, meaning tools, of the risk markets. They use interest rate swaps and treasury bond futures contracts. Let's look at interest rate swaps in our example. So the bank opens an interest rate swap in the interest rate risk markets. It pays into the swap fixed payments, not all of the fixed payments coming out of the loans, otherwise there'd be no margin, no profit, but a portion of it, and they pay into the swap what they've got and they receive what they need to discharge their liabilities. They need the cash rate. They actually get the bank bill swap rate, but that's close enough for this purpose. So if the bank doesn't have the interest rate risk, who does? The counterparty in the swap. And if they're going to absorb interest rate risk, then they need payment for that. And at the beginning of the swap, that's about 40 basis points in March of last year. The fixed payments at the beginning of the swap are more than the floating payments by about 40 basis points. What the bank's paying is more than what they're receiving by about 40 basis points, but they've laid off the interest rate risk. So now we can see across all of the components, the total funding cost for the bank, the cash rate plus 80 basis points. So then in March of last year, as we were plunging into the COVID-19 crisis and no one knew where the bottom was, the RBA decided to introduce a bunch of different measures for monetary policy, one of which was the term funding facility. And in the term funding facility, the RBA offered to banks and building societies and credit unions 3-year money at the fixed rate of what the cash rate was at that point in time. To begin with, it was 25 basis points. Now, since November of last year, it's 10 basis points. So the RBA is offering to this day, but ending on the 25th of June, to banks and building societies and credit unions, 3-year money at 10 basis points, fixed at 10 basis points for 3 years. Now, as you can imagine, that had a big effect on the funding costs of banks. And in particular, it reduced this 40 basis points and it got rid of the need for interest rate hedging. because now we have got asset liability matching. The liabilities are fixed rate and the assets are fixed rate. Fixed rate payments are coming out here and some of it is being made into there. So there's no need for interest rate hedging in the swap market anymore. And the total cost of funding for big banks is the cash rate plus 0 basis points. So what happens now? Now that the term funding facility is going away, do we expect the interest rate on 3-year fixed rate mortgages to jump up by 80 basis points? Well, no, because there's a couple of important things that are different now, and let me point out what they are. One thing in determining how much banks are going to have to pay for, banks and building societies and credit unions are going to have to pay for their funds, is the amount of money that they have in their accounts at the RBA. These are called exchange settlement accounts, and ordinarily they'd have 20 to 30 billion in those accounts at the RBA, but at the moment they've got 260 billion, and the RBA doesn't pay any interest on those accounts. So they can take money out of their exchange settlement accounts and lend them into the market. And so the effective cost here is 0. That's the opportunity cost. They're foregoing 0 interest by leaving it, by not leaving it with the RBA. And so that's actually the cash rate minus 10 basis points, because the cash rate's at 10 basis points. So they can fund it at less than 10 basis points simply by taking the money out of their exchange settlement accounts where they're getting 0 interest. What about interest rate risk? Well, the cost of these swaps at the moment is about 35 basis points, the difference between the fixed payments and the floating payments at the beginning of the swap. And when we add those things up, we get to the cash rate plus about 25 basis points. Well, there's also competition. So we should expect less competition for the big banks from the small banks and credit unions and building societies when the term funding facility goes away. It's not that easy for small banks and credit unions and building societies to make 3-year fixed rate mortgages or to make fixed rate mortgages. It's hard for them to get rid of the interest rate risk. Of course, they can and do that. They actually use the big banks to access the interest rate risk markets. But that's tricky and expensive for them. So they're more inclined to simply withdraw back to making variable rate loans. So they'll continue to make fixed rate loans, but there'll be less competition for the big banks when the term funding facility goes away. And we can see that here, 25 to 30 basis points for increased funding costs, 20 to 25 basis points for less competition. That's my estimate. What does that mean for homeowners and investors? It means that homeowners and investors who have been holding off from fixing their mortgages because they're waiting for fixed rates to bottom should stop waiting for them to bottom. Once the term funding facility comes to an end, the interest rates on fixed rate mortgages are heading up, not down. So now's the time for action. Now's the time to the ending of the term funding facility should crystallise action amongst those homeowners and investors. So I hope you've enjoyed this video. This video runs for 9 or 10 minutes. My investors course, Finance Education for Investors, which you can find at windlestone.com.au, runs for 30 hours. The next course, which starts on July the 14th, runs over 8 Wednesday evenings from 7 p.m. to 9:30 p.m. Australian Eastern Standard Time. There is those classes, which are Zoom sessions, and summaries of those classes and lots of supplementary materials provided through a learning management system. It's a very comprehensive course which gives you empowerment and gets you to better outcomes. So if you're interested in coming to an information session, that's on Wednesday, June the 16th. Go to windlestone.com.au to register for that information session. And if you'd like to just simply enrol in the course directly, again, go to windlestone.com.au to enrol in the course which starts on the 14th of July. So I hope to see you then and in the next video as well. Thank you.